Look at any chart right now. Somewhere on it, price is making a decision. It is either building higher highs and higher lows, or it is building lower highs and lower lows. That is it. That is the entire foundation of every trend that has ever existed. And yet almost nobody trades it correctly. Why does something this simple get ignored by traders who have read every book on the subject? Because simple does not mean easy. Simple means there is nowhere to hide. There is no indicator to blame. There is no news event to point to. There is just you, the chart, and a structure you either understand or you don't. Let's fix that today. Market structure is the skeleton underneath every price move. Strip away the candles, strip away the colors, strip away the noise, and what you are left with is a sequence of swing highs and swing lows. When each new high is higher than the last, and each new low is higher than the last low, you are in an uptrend. When the opposite happens, lower highs and lower lows, you are in a downtrend. Charles Dow described this over a century ago, and it still holds because it describes human behavior, not market conditions. Buyers stepping in earlier each time. Sellers stepping in earlier each time. That is all a trend actually is. So why do traders miss it? Most traders are looking at the wrong time frame for the wrong reason. They zoom into the 5-minute chart hunting for entries before they've confirmed structure on the time frame that actually matters for their trade. They see 3 green candles and call it a trend. 3 candles is not a trend. 3 candles is noise wearing a trend's clothing. Here is the first rule you need to internalize. Structure is confirmed, not assumed. A higher high is not a higher high until it closes above the previous swing high with conviction, not just a wick that pokes through and reverses. A lower low is not confirmed until the same thing happens on the downside. Until that confirmation happens, you are guessing, and guessing dressed up as analysis is still guessing. Let's talk about why this matters more than almost anything else you'll learn in trading. Every strategy you will ever use, price action, supply and demand, indicators, moving averages, all of it works better with a trend and worse against it. Linda Raschke built much of her career on this exact idea, trading with the dominant structure and using pullbacks as entries rather than fighting reversals. This is not because trends are guaranteed to continue. They are not. It is because probability favors continuation until structure proves otherwise. You are not predicting the future. You are aligning yourself with the path of least resistance. Now here is where most traders go wrong a second time. They correctly identify the trend, and then they enter at the worst possible location within it. They see a higher high forming, get excited, and buy directly into resistance instead of waiting for the pullback that almost always follows. Structure tells you direction. It does not tell you timing. Those are 2 different skills, and conflating them is one of the most expensive mistakes in trading. So how do you actually use this? Start by marking your swing highs and lows on the higher time frame, the 4-hour or the daily, depending on how you trade. This is your map. This tells you whether you should even be looking for buys or sells at all. Then drop to your execution time frame, the 15-minute or the 1-hour, and wait for price to pull back into a zone of interest, an area where the previous move originated, a broken structure level now acting as support, or a supply and demand imbalance. You are not entering because the pullback happened. You are entering because the pullback happened at a location that matters. This is where a break of structure becomes so important. A break of structure is the first sign that the current trend may be ending or pausing. If price fails to make a new higher high and instead breaks below the most recent higher low, that is your signal that buyers have lost control, at least temporarily. This is often the earliest and most reliable clue you will get, well before any lagging indicator catches up. Smart money concepts, popularized more recently by educators like Michael Huddleston, lean heavily on this exact mechanic, tracking where structure breaks to anticipate where liquidity will be taken next. Let's address the part nobody wants to talk about. When does this fail? It fails in ranging markets. When price is chopping sideways without clear directional swings, forcing a trend following structure read onto that price action will get you chopped up in false signals. It fails around major news events when institutional order flow overwhelms normal structural behavior for a period of time. And it fails when you confuse a temporary retracement for a full structural break, exiting trades too early out of fear rather than analysis. Structure is a probability tool, not a certainty machine. Anyone who tells you otherwise is selling you something. This is also where risk management becomes inseparable from structure itself. Your stop loss should live beyond the structural point that would invalidate your trade idea, not at some arbitrary number of pips you picked because it felt safe. If you are buying a pullback into a higher low, your stop belongs below that low, because if price breaks it, your entire thesis is wrong. Risking based on structure rather than random distance keeps your losses tied to your actual analysis instead of your comfort level. Think about how differently that feels from the way most beginners trade. Most beginners choose a stop-loss size first, then look for any excuse to enter. Professionals do the opposite. They find the location where their idea is proven wrong, and the risk is whatever distance that happens to be. If that distance is too large for the position size, they skip the trade or scale the size down. They never move the stop just to make the math feel more comfortable. There's a deeper reason this framework works over the long run, and it has nothing to do with predicting the market and everything to do with consistency. When you trade the same structural rules every single time, your results become measurable. You can review 100 trades and see exactly where your edge holds and where it breaks down. Traders who trade on discretion and gut feeling can rarely do this, because their rules change from day to day depending on mood. Structure gives you a fixed reference point, and a fixed reference point is what makes backtesting even possible. So where do you go from here? Pull up your charts. Choose one pair, one time frame you trade most often. Go back through the last 3 months and mark every swing high and every swing low by hand. Don't use an indicator to do it for you the first time. Do it manually, so your eyes and your brain build the pattern recognition that no shortcut can replace. Notice how many trends were obvious in hindsight, and notice how often the actual break of structure happened much earlier than you would have guessed while you were in the moment. This exercise alone will change how you see every chart afterward. Because once you can see structure clearly, you stop needing 15 indicators cluttering your screen. You stop needing someone else's signal group to tell you what to think. You start reading price the way it was always meant to be read, as a record of decisions made by buyers and sellers in real time. Higher highs, higher lows. Lower highs, lower lows. That is the whole language. Everything else is just dialect. And now you know how to speak it, and more importantly, you know why almost nobody actually does.